All right, lots to talk about. Let's welcome on board Sandip Sabharwal, who's joining in on the show. Sandeep, let's start off by getting in your sense then overall on the entire auto space, because it continues to remain fairly mixed when it comes to this basket. We've got the latest brokerage note from CLSA on Bajaj Auto, and they're saying that they are cautious on competition within premium motorcycles, while the Bajaj and Triumph launch does look promising. Your take?
So I think in the auto sector, what's happening is that firstly, in the equity market, a lot of money is coming in because of flows into mutual funds and other asset managers. So wherever there is some positivity, so the majority of the money is going there. So over the last couple of months, we've seen that the growth rate on the four-wheeler side has slowed down, and as such, the entire attention has gone into the two-wheeler companies. On top of that, for companies like Bajaj Auto, the export picture also seems to be improving somewhat. So that's what has been driving the stock prices of Bajaj Auto, Hero MotoCorp, etc. higher. Bajaj Auto obviously has been a big outperformer over the last 2, 3 years also because of their strategic uh, the way they have actually grown the overall market for themselves and the what they've done in the export markets. So this could continue for some time, but the valuation now are becoming slightly excessive. And in case, like the four wheelers, there is some growth slowdown in two wheelers, then I think these stocks could take a short term hit. Longer term, I think most of the auto companies will still benefit from the pickup in discretionary spending and easing of monetary policy over the next couple of years.
Yeah, and that's Sandeep. Hi, morning. Firstly, that's exactly what I wanted to talk about because overnight you're seeing that there are heightened expectations. I mean, looking at the CME Group Fed Watch tool, that traders and almost a 63% of them are actually now pricing in a 50 bips cut. And your own thoughts on where the RBI is headed in terms of both the inflation as well as growth dynamics.
So, if you look at the economic data coming out of the US, it does not make a case for a 50 basis point cut actually, because the economy has been quite resilient. Even though job additions have slowed down, the layoffs continue to be moderate. So, fundamentally, there's no case to become aggressive because an aggressive cut would indicate that the Fed is actually very concerned about economic growth. So, I think in case there's just a 25 basis cut, we could see a knee jerk sell off. Now, RBI governor has been constantly talking of food inflation, although the headline inflation has been below 4% for the last few months. And the way the monsoon has panned out, the probability that food inflation will fall off the cliff actually as we enter into the winter months is very, very high. So they need to be proactive and take actions to support growth. Now, the comments do not indicate that they are likely to do that, but actually they should be on the easing cycle now. The good thing is that they have at least let the liquidity build up, which has built up as the government started to spend after the elections, which reduces some risk for the economy.
What is your own sense on metals? I mean, there have been all those global growth concerns, recession concerns as well in the US, China slowdown, etc. China realty under pressure, all those factors on one end. But do you think metals could be poised in for a meaningful recovery from here? I mean, Kunal is reading on the charts and saying, yes, it can, but would it fundamentally make sense to invest?
See, fundamentally, if you look at it, there's no justification for a significant rally in metals because still overcapacity persists and China continues to be on a downturn with no likelihood of any recovery in economic growth. In that scenario, the commodity demand will remain subdued. And this is reflected in the most liquid commodity, which is crude oil, where the prices are more near yearly lows rather than at higher levels. Most of the other metals have also corrected. If you look at steel prices, iron ore prices, but many of these stocks continue driven by liquidity at more near 52-week highs. So that's a dichotomy. So in that scenario, even if let's say there's hypothetically an improvement in metal prices, then still that's already factored into these commodity stock prices. So I don't know, unless and until there's a huge recovery in metal prices, which seems unlikely, uh, I wouldn't think that there is too much potential across the board.
Okay, makes sense. Citi has come out with its note on Bajaj Housing and the kind of rally that the stock has seen ever since its listing and the kind of subscription that the IPO got. Now, what they're saying is that bank portfolios are similar to the companies and they're valued at steep discount. Sandeep, pretty much an extension of the point that you were making last afternoon as well, right? That why a fancied, frenzied Bajaj Housing when there are so many other listed players in the same space doing the same business?
Yeah. So if you remember, Aisha, why did HDFC get merged into HDFC Bank? Because the competitive intensity in housing finance had become so intense that as a standalone entity, for them to be bulk borrowers in the market and to sustain profitability at the level which they were doing historically was very tough. So in this scenario, how can we assume that Bajaj Housing will be something different? Like obviously, if you start off a smaller base, initial years you grow much more faster. But then housing finance is a business which has issues related to continuously falling margins because uh, and every financial institution is into housing finance now, and the ROAs also will be lower than many other lending businesses. So I find it tough to understand the valuation at which this stock is trading. The only explanation is low liquidity, and that has driven, and the buying which is happening, that's driven the price up.
Fair enough. That's the view coming in. In the meantime, Sandeep, also curious to understand your outlook on some of the large cap stocks within the entire banking space as well. And just talk about how we've looked at like the likes of a Kotak Bank, ICICI Bank, HDFC Bank, etc. What's your outlook as to how you expect these stocks to trend?
So most of these banks, like for example, I think ICICI Bank is already at a new high, while many of the other large cap banks are still not there. So that shows leadership, that there's more conviction in the growth strategy and the margin resilience of ICICI Bank. Overall, the financial sector is a big sector among the large cap universe. So if the funds flow continues, then obviously they'll also slowly keep on moving up. But next year, in terms of pure earning growth, if you just look at the earning growth picture, could be tougher for banks overall because the initial cuts by RBI will actually hit their margins, plus the deposit credit mismatch still has to balance out, and that would mean lesser credit growth next year. And the NPA cycle also seems to have bottomed out. So to that extent, there could be slightly high uh, amount of write-offs from next year onwards. So I think those are the issues which are keeping the financials down. But longer term, as the economy grows at a nominal growth rate of possibly 11 to 12%, I would think that most of the large banks should be able to give returns between 10 to 15%.
When you say you expect write-offs to start, NPS to start going up, are you referring to the unsecured category, Sandeep? I mean, where is this? What is the basis of this point?
Initially, it always starts with unsecured because most of the secured lending will be in projects which have long gestation. But I think there are issues longer term because a lot of the money is going into financing many solar projects, solar manufacturing companies, many of the businesses where I think the profitability will not be as high as, or renewable energy overall will be as high as what people are expecting. And the second could be some concerns around metals, etc. Also, where the prices are down, so profitability could get suppressed. The MSMEs continue to be under some stress even now. So that could be another concern area. So we are not looking at a big NPA spike cycle, but given that most of these banks are now at 0.3, 0.4 net NPA, it is impossible to go below that. So incrementally, there'll be some extra write-off starting next year, but it will not be a reversal of the NPA cycle in a way.
All right. Meantime,
We are in for a good start. That is what markets are indicating. Sandeep, you may want to call them government-dominated stocks. Some would like to call them Modi sensitives. Some would like to call them policy sensitives. Bottom line here is that the wind is out of the sails for a lot of defense, railways, and the so-called shipyard names. They are down 15, 20, even 30% from the recent high. Are we in for long-term tops which have been made for some of these stocks, Sandeep?
I think there'll be two factors: how the overall market does, and that will also determine how these stocks do. So, in for many of these companies, let's say defense or shipyard specifically, I still believe that there's a lot of long-term growth visibility. It's just that the valuations became so excessive and are still excessive in the near term. So at some stage, I think they could become decent buys um, because of the pure earnings growth outlook, which will be strong. And many of these companies don't have debt also. So to that extent, we don't have those concerns also.
And what is your definition of attractive?
I think it'll depend on stock to stock. I don't think many of the PSU companies deserve to trade at 70, 80p or 50, 60p, or the PSU financiers can trade at valuations which are the same as large private sector banks. They need to be at a discount to that. So, for example, the PSU financiers need to be at least at a 25-30% discount to private sector finances, because historically we've seen that in NPA cycle reversals, they will always take a big hit. Most of these defense stocks are still at some 50 plus P. So they need to moderate to maybe into the 30s.
okay, that's the word coming in. Sandeep, we were talking about this earlier this morning that perhaps while the markets, of course, are continuing to look fairly stable day after day, all the action is really in the primary markets. Of course, you did touch upon Bajaj Housing Finance, but I just want to know how you're looking at the kind of action that we're seeing within the primary markets, the listings day after day, the valuations, the issue prices, etc., of some of these companies, and what you make of it.
Yeah, so initially, I think in the show you were talking about how Morgan Stanley is positive because of high issuances, which I find quite intriguing because the supply is so high and the quality of the supply incrementally, let's leave aside a few companies, is actually declining, and most companies are coming at higher and higher valuations. It's not, cannot be said a positive. So it's good for the companies who are raising capital because they get growth capital. But for the investor universe, the sustenance of many of these stock prices depends on the bullish sentiments continuously continuing. So I think that this high supply, I would think, is a risk for the market rather than a positive.
1 lakh crore. Another surprisingly strange fact for me is autos. Company after company in the four-wheeler space are acknowledging and admitting that, look guys, it's not all that hunky-dory. Whether it is the waiting period or ability for us to demand premium from the customer. Waiting is out and discounts are back, and yet auto stocks are holding on.
I think that's the feature of the market, right? Commodity stocks are more near all-time lows or 52-week lows, and the commodity index, like Kunal was pointing out, is at a new high of 50 or 52-week high. So it's all liquidity driven. So I think in this scenario, people need to look at valuations, what could come in the future, whether there's likelihood of growth revival, and whether the valuations and growth match. So I wouldn't be very negative on autos because I still think discretionary spending will bounce back, and for them, because the commodity prices have been down, so they could still hold on to margins. But the way many of the two-wheelers have rallied in the near term, that all seems a bit excessive in the near term.
All right, thanks Sandeep for joining in and sharing with us your thoughts. The pre-open.
If you like this video, then like, share and subscribe to ET Now.